In a recent video, I briefly went over what the term HELOC meant in the mortgage world. Well, today I want to go into a bit more depth on what these loans are and how they work. So let's get started. I'm wearing red. Why am I wearing red? Because it's Friday, and here at Low V Rates every single Friday, not just me, but our entire staff wears red. It's an outward expression of how we feel inside about our military veterans, active duty service members, and anybody really that loves this country. If you love this country and you love our veterans, wear red every Friday as a way to kind of say thank you. Now, speaking of red, look down there to the bottom right corner of your screen. There should be a red like, subscribe, follow, whatever it says. Click it. Find out a way to do that, but please follow along on all of our social media and different YouTube, Facebook, Instagram, TikTok. I don't even know what they're called. My kids are now doing something called Be Real. Who knows when we're going to end up on Be Real? I don't know, but we try to be there for you guys so that you can be educated and you can learn all you need to learn about VA loans and other types of mortgages. Today, we're going to talk about HELOCs. Okay, that's what we're going to talk about. In case you missed one of the other videos or you've forgotten what they are, that's what we're talking about today, HELOCs. HELOC stands for, here you go, home. Wow, I like this new marker. Equity line of credit. Home equity line of credit. Essentially, this is a type of loan that uses your home as collateral, and it allows you to yank out all that equity that you have. So what happens is lenders like Low V Rates, we look at how much your home's worth, that's the appraised value, and we use that to determine how large of a line of credit you might be able to get, okay? However, unlike other loans involving your home's equity, HELOCs, cash out, refinances, HELOCs aren't like a one-time get all your money at once and you're done with it type of thing. Instead of being like an installment loan, a normal type of loan like a car loan or a home loan, they provide access to a revolving line of credit, similar to maybe like a credit card, but way safer, way better interest rates, way more advantages. But that's why it's a line of credit. You can draw it up, you can pay it down, you can draw it back up. Okay, so as you pay off the balance of your home equity line of credit, then the amount of available credit to you becomes replenished. Okay, I want to talk to you exactly how that works. For starters, HELOCs are not a permanent source of credit. Typically, the loan term is structured into two separate periods of time. I want to get into this. There's the draw, okay? There's the draw period, and then there is the repayment period. Okay, the repayment period. The draw period is always the first part of the loan. It's done up front, and it typically lasts for 10 years maximum. During this time, you can borrow as much money or as little as you want, up to the limit established at closing. You're going to have a draw limit. Now, each month, you have to pay at least the interest that was accrued on what you've just borrowed. However, you can also choose to pay back the entire balance or a big chunk of the balance, and what this does is it replenishes your line of credit or what you're able to access. Once the draw period ends, like I said, sometime maybe, 5 to 10 years, but we'll focus more on the 10 years. There's a good amount of time to be able to draw. Well, after that period of time, your repayment period begins. The repayment term or period is often structured to last about 20 years, making the total term of your HELOC somewhere between 25 to maybe 30 years, okay? So I'm gonna put here that your repayment term is normally around 20 years. Could be shorter, it just depends on how you structure the loan. Now during the repayment period, you can no longer go in and start tapping into any additional equity that's left over. You can no longer access your equity. Instead, you're strictly limited to paying back the outstanding balances plus any interest that you've been accruing until you've paid back the lender in full for the balance of the loan and all the interest. So let's talk about how interest on a HELOC works. Can you erase this up real quick? Going to talk about how this interest works on the home equity line of credit. One day I'm going to invent a marker that really cleans the whiteboard. Okay, like credit cards, the interest rate for a HELOC is usually variable, and it can change from month to month. Variable, or most of you guys are familiar with the term ARM, adjustable rate mortgage. Okay, that's also how credit cards work. Now, what rate you qualify for is based on two things. The index, okay? We've got a lot of cool videos out there about ARM loans, so I'm not going to go into too much detail unless I decide I just want to go down that path, but we're going to keep it somewhat simple. There's the index, which is based on current rates at the time, and that index moves up and down as the market changes, and a margin. Index and a margin. Two main ingredients in an adjustable rate or variable rate mortgage. Okay? And the margin is usually a fixed amount that gets added to the index right here. So, right, when you take your index plus your margin, what you get is your fully indexed rate. Essentially, the interest rate that you're going to have at the time of closing. Now, while you don't personally have a lot of control over the index and what it does, the amount of the margin is determined by a lot of factors that you do have some control over, okay? So this margin is something I want to focus on right now. Who gets the best margins when they're getting a HELOC? Well, if you've got good credit scores and good credit history, right? You're a strong borrower, low risk. If you've got lower LTV, so you're not trying to cash out all the equity in your home and push that LTV as high as you can, you're going to borrow less money in some cases. These things make you stronger and may help you qualify for a lower margin up front. And with a lower margin, going forward, your interest rate could be lower than somebody that has a higher margin. So unlike adjustable rate mortgages, which typically only adjust once a year, HELOCs, so we're talking about here, right? These lines of credits do have the ability to adjust in many cases more often than once a year. It's not uncommon for rates on HELOCs to adjust as often as monthly or even every 6 to 8 weeks. However, you should know this. HELOCs are legally required to have caps. Okay, we talk about that in a lot of our other adjustable rate mortgage videos. Now these caps, might as well write it down just so you guys can take some notes or go search for some of our other videos. These rate caps help protect you if interest rates just skyrocket. It wasn't just about a month or two ago that the Federal Reserve increased interest rates by 0.75%. It was like the highest increase in interest rates by the Federal Reserve in something like 15 years or something like that. They're supposed to be doing it also again here very soon. So let's say interest rates start skyrocketing. If you've got caps, which we put caps on our HELOCs here at low VA rates, it's going to make sure that your interest rate doesn't just skyrocket to like a height that you can no longer afford the payments, okay? Now these HELOCs that we're talking about, there's all sorts of them. There's much more variables. There's many more products out there than there would be for kind of like a standard VA mortgage. So HELOCs are not required to have periodic rate caps. So as long as the lifetime cap, what your rate can get to over time, doesn't exceed a certain maximum cap, all right? So you might see a quick jump in 1 month, but if it goes super, super high and it exceeds the lifetime cap, it's gonna stay down. It's not gonna go that much higher. Now, just like other loan products, you should be shopping around for HELOC rates and programs and margins and all of this stuff across at least 2 or 3 lenders like we've taught you with all of our loan programs here at Low VA Rates. Why? Because shopping can help you secure the best possible options. Now, I want you to make sure you're not just being offered a teaser rate that's only going to last for maybe the first month or the first year, and then you're kind of convinced to go with this route. There's a 0.99% rate. Well, if you read the fine print, make sure you're always reading your documents or call us up and let us help you. Make sure you're not being swayed by a teaser or introductory rate. Here's how you're going to qualify for the home equity line of credit or the HELOC. Okay, now every lender might have somewhat different qualifications, But in general, throughout the industry, here's what you're going to have to think about. Number one, you need to have equity in your home. Okay? There is zero reason to be looking into a HELOC if you have no equity. If you're a veteran and you just bought your home last year, you put no money down, you borrowed 100% of your home's purchase price, you're not going to come out today and get a HELOC, because housing prices have not gone up enough in the last year. Maybe they have, but in general they haven't, and they're actually starting to settle down a little bit. So don't even look into a home equity line of credit if you don't have equity. Most lenders are only going to allow you to borrow 85% as a maximum of your home's value, okay? Minus whatever you already owe on your first mortgage. That's why I was just saying, if you borrowed 100% on a VA first mortgage, there's not going to be a lot of money left, if any, to go borrow on a HELOC. In addition, you're going to need to meet the other requirements that your lender likely has, which are going to be things like, decent credit. Doesn't have to be perfect, but it needs to be decent. And on our VA loans, as you guys know, those that have been following us for years, we have no minimum credit score. There's definitely credit minimums, credit score minimums required on HELOCs. You're going to have a job, okay? You're going to have income, these sort of things like would be normal on any other sort of loans, because there's a maximum debt to income ratio, and that's what we use to determine what your debt to income ratio is. Now, how are we going to determine if a HELOC is the right loan for you? When it comes to accessing your home's equity, you do have a lot of options. In addition to the HELOC, which I just talked about, you've got cash out refinances, and you've got HELOans, or home equity loans. So when you're trying to determine which of those products or any others out there are best for you, you got to make sure you understand what you're planning to do with the money, how you're going to use it. If you just want a one-time payment to cover a project like a home renovation, you've got to pay for a wedding, or you're going to go pay off 10 credit cards all at once, well, then a HELOC might not be best for you. Maybe a HELOan. But if you're looking to be able to access your equity over time, home equity lines of credit might be a better choice. What would I mean by that? Well, I only need $5,000 a day because we don't have a whole lot of debt. I got a car that's in the shop. It's $5,000 to replace the engine, but I can see 3 or 4 years down the road, my 14-year-old might be going to college. My son might be getting married. So I do want to be able to access my income later. I do want to access my equity later, but I just don't need to access it all right now. Then maybe the home equity line of credit is for you. That's just a quick, simple way to look at it. Everybody's situation is different. What I want you to do is make sure, more than anything, is that you're always tuning in, okay? That you are subscribing to our webpage. That way, every time something comes out, or if you're interested in the HELOC, if you go and make a little comment on this video, next time somebody else comments on it, you're likely going to get a notification, and you can always be at the top of your game on this stuff. Now, if you're not patient and you can't wait until next week when I'm going to start doing another really, really cool video to try and figure out if a HELOC or a different option is right for you, feel free to call us, because we're always willing to give you free advice. There's no obligation. We're not tying you down. We just want to help you meet your financial goals and educate you. So until next time, I hope you have a great rest of your Friday. You better be wearing red, by the way.